I work for Advocate Aurora Health, which is the largest hospital system in Illinois and Wisconsin. We manage a large pool of capital. You can think of it like retained earnings of a not-for-profit. It has a very endowment-like function, backstops our organization, which is particularly important in times like this, where the organization, has a lot of capital needs. My area of focus is all alternative assets. So I cover hedge funds, private equity, and private real assets. Hedge funds serve a really important role in our portfolio, and that takes up a lot of my time. So I really want to highlight their importance and how interesting they are and how much I've enjoyed them. So my background's in credit. I spent, about 10 years at a CLO underwriting senior secured bank loans. Started just out of school in transaction advisory services at Ernst & Young. Undergraduate majored in business economics, so not finance and accounting specifically, but was really drawn into the finance world and loved sort of the M&A and deal aspect, which is how I kind of ended up on my path. So that's my background. Maybe I'll turn it over to Therese and we'll go from there.
There we go. I think everyone hopefully can hear me. My name is Therese Best. I also have a Chicago connection. I grew up there and lived there until I graduated from high school. After that, I majored in econ and I got a certificate in finance at Princeton. And then I started I did 2 years in an M&A program in investment banking. And then I started at Caspian, which is a hedge fund. We are a $3.5 billion investment advisor in New York. We focus specifically on investing in the corporate credit markets. We invest in high yield bonds and bank debt specifically. I started there as an analyst and then became the head of research. And now I act as our COO and chief risk officer and the head of our valuation committee.
Amy, do you want to go next?
Yeah. Thanks for having me. I'm Amy Rose now. My background, I started my career as an equity derivatives marketer, so working on derivative strategies for hedge funds, pension funds, insurance companies, and endowments. I was living in New York then. I moved to Chicago actually for my husband's job and joined Morgan Stanley and worked for them in their prime brokerage division, where hedge funds were then my clients again. And then I went to work for Sheffield Asset Management, which is a equity long-short hedge fund. And I, similar to Therese, served as their chief operating officer for a little bit over a decade. And after Sheffield, as an unrelated to this panel side note, I had a startup creating software to make it easier to be a working parent. And I now manage a small family office and I'm incubating some other startup ideas as well.
Hi, everyone. I am Stephanie Szymanski. I'm Director of Investments at Gore Creek Asset Management, which is the family office for the Galvin family located in Chicago. This is the family that founded and ran Motorola for 3 generations until the early 2000s. Prior to working for Gore Creek, I was at another family office for 11 years. And one thing I want to explain, I had no idea what a family office was before 2007. So I thought I'd take a second and explain that. And it really is exactly what it sounds like. It's an investment management firm started for the benefit of investing, often for one family. And so the Galvins have 4 generations of living family members from 18 months to about 96 years old. So we invest their combined wealth in a portfolio very similar to what Laura described, which was mostly in funds and a lot of alternatives for us. So we're about 40% hedge funds and 32% private equity. So as a generalist, I'm covering all asset classes around the world on behalf of this family. Pretty much if you think of any big business, there's probably a family office behind it. Like in Chicago alone, we've got Motorola, Crate & Barrel, Macy's Northern Trust, Hyatt. So a lot of these little hidden family offices exist out there. My role, similar to Laura's, is to find, meet with, perform due diligence on, and then recommend investments in any number of funds across asset classes. And together with my CIO and fellow director, we decide on the portfolio construction and management from there.
Wonderful, thanks. You can see how grateful I am for all these busy women to take time out of their days to join us. I thought we'd start with Therese. I thought, you have seen so many different angles of a hedge fund, and I guess if you had to explain to someone, because the word hedge fund can mean a lot of different things, and if you could sort of help demystify and talk a little bit about what is a hedge fund, and then kind of kick us off and maybe talk a little bit about your career path, et cetera. We'll turn it over to you to kind of start us off.
Sure, that is definitely a good question to ask before you start working at one. I sort of asked it before I started working at one in 2002, but I now have a much better idea what the answer is. A hedge fund ultimately is really just a legal structure. It is a legal structure that people use to make investments. Google will tell you a slightly more complicated sounding definition of pools of money for sophisticated investors who can absorb potential losses that risky trading generates. But really, it is a way to pursue an incredibly diverse number of strategies. Like a hedge fund isn't just any one thing. You have hedge funds that are pursuing long-only strategies or distress, special situations, credit, macro, equity, arbitrage, activists. They can buy real estate or Bitcoin or make direct loans. But a hedge fund can be tailored to the requirements of the investors that are investing in it. And so they can have very specific mandates, they can have very broad mandates, but across the industry, there are fewer restrictions on things like using leverage, fewer restrictions on diversification or on shorting that you would get if you were comparing it to a mutual fund, for example. I think one of the interesting things about hedge funds, and that I think gets into a question we were talking about when we were preparing for this, is, why is it different? It's because we can hedge. And what is hedging? Hedging allows us to make riskier investments because we are able to protect the downside than if you were in a more regulated sort of structure such as a mutual fund. I will say when I started a hedge fund, other than sort of the general definition, I don't know if I really knew what a hedge was. But a hedge is essentially you have a position and you're going to take a second position that reduces your chance of loss if you're wrong. It doesn't necessarily take it away. You can still lose money, and it will reduce your upside if you are correct. But it is a way to structure your portfolio so that in downside scenarios, you do not sort of lose everything. And hedging is actually something, I was in thinking about it over the years that we're all doing all the time. We just don't call it that. I'm a mother of 2 young children. I recently redid my life insurance. Life insurance is essentially a hedge that people make. They take a look at it. They say, my life insurance policy is for 20 years. So if I'm in good health for 20 years, at the end of 20 years, I will have paid a lot of money out the door. And it may not have looked like a good investment because I paid this money for insurance, essentially, to make sure that my family is okay if something goes wrong. But if something does happen to me, it looks like a great investment because the insurance paid off. And so hedges, if you're right and nothing happens to you over 20 years, which is what everyone hopes is the case, the hedge may reduce your return a little bit. But if you're wrong, and a month after I start my insurance policy, not to be too morbid, but if I get hit by a bus the month after I start my insurance policy, that was a fantastic hedge. So hedges are also all not only in how you set it up, but it's all in the timing. How long does it take to play out? When does the bad scenario happen? So I guess that's how the simplest way to think about hedging.
That's a really great example. And I think it's great to put it in such understandable terms because, that's something we can all visualize. So Therese, as you are, kind of now, you've moved up the path, when you as a hedge fund are going to look for potential candidates, kind of where do you find candidates and kind of what backgrounds are really well suited? And you can speak a little more broadly than just your firm if you have insight into, sort of the hedge fund recruiting process overall.
I think we, like a lot of hedge funds, except, there are a few that are very large, are still ultimately kind of a small business. We have 25 employees, and we don't ourselves necessarily have the infrastructure that you would have at something like an investment bank or a law firm to train a huge number of people just from zero to I guess productivity. And so we hire out of those bigger institutions a lot of the time. We hire out of for analyst jobs, we hire out of investment banks, equity research jobs, advisors, sales and trading desks. We hire from prime brokers. We hire from other allocators. We hire, from law firms if it's a legal position. But we really are looking for, depending on the position, someone who has a couple years of experience, someone who has really, had the additional training and some exposure to the market. And then, we find people through a variety of sources. A lot of times it's through other contacts in the industry. I think it's fairly typical now, for example, for analyst positions, for it to be fairly open at a bank that people are looking for a job and looking to move on to something like the buy side. And so, people talk to their friends, anyone who's good. We do use some websites and things like that as well. But I think a lot of times, because it's not a formal recruiting process where we're hiring, 20 or 100 people every year, it's just meeting people who are looking and finding the right fit, because personality is important in terms of fit. When you're 25 people, it's important for the person we're hiring too. They need to also like us. There's nowhere to hide in a small business.
Right. Maybe Amy, I would love to hear, sort of, while Therese demystified kind of what is a hedge fund, when, you have young, people looking to enter the workforce or looking to work for a hedge fund, maybe you could talk about some of the different kinds of roles, because just as there is no one type of hedge fund, I know even within a hedge fund, there's so many different paths you can take. So that'd be kind of great to hear, as people are sort of considering different career paths, what opportunities exist within hedge funds.
Yeah, absolutely. So I think when people think about working at a hedge fund, what jumps to front of mind is the investment positions. And pausing there for a second, I think it's a great time to be a woman who's interested in being an investor. And I would strongly encourage anyone in the audience for whom that is a passion to try to pursue it. There's not enough of us doing it, and there's not enough of us staying there. And I think the market is really coming to recognize the value of having all different perspectives coming to the table. So if that's your path, definitely go for it. But also know that there are other paths into the industry, and those are on the operational side in everything from accounting, marketing and investor relations, compliance, legal, office managers. These are really at their heart small businesses, which, well, the one that I worked at was a small business. Therese as well. I think when you start looking at like the Citadels of the world, we're no longer looking at small businesses. But for many people in the hedge fund industry, the vast majority of firms are small businesses, which is what makes them really fun to work in, because at any position, whether you come in on the operations side or the investment side, you have more impact, more flexibility, and more experience. Like, you get to really dig your hand in than you would in some of the larger organizations, which I think is what makes it really fun.
Yeah, and I guess as an allocator, one thing that, your comments just sort of reminded me was how in our role, and Stephanie, I'm sure you can speak to this as well, you're not just underwriting a hedge fund's ability to invest, you're really underwriting their stability and their ability to kind of function as a business as well. Because, they need to retain their capital and retain talent and stay in business for you to see your investment come to fruition. So, one interesting part of an allocator role is sort of the not just analyzing the kind of hard numbers and the quant stuff, but the things that you can't maybe see in the numbers, which is, speaks a lot to culture, stability, ability for this shop to retain talent and capital. So, Amy, I guess another thing that would be kind of interesting, I guess a couple of us could talk about this, but sort of your experience as a working mom in the hedge fund industry. For anybody that's looking, kind of, I think there might be some myths that the hedge fund industry, doesn't have a place for work-life balance. I guess I would love to kind of hear some of your thoughts on that. I know you had some interesting perspectives.
Yeah, I actually think the hedge fund industry is a great place to be a working mom. I think at the end of the day, the markets don't care whether you have kids or don't have kids, whether you're male or female, where you went to school. Like, you do the analysis, you do the work, and ultimately you will be proven right or proven wrong. And that there's something very, I think, satisfying about that. And the dynamism has always, I think, been appealing to those who join there. I think at the right firm, and the nice thing about these being small businesses is that you can find a firm that has a good culture and you can come to a culture and shape it. I was the first person at my firm to ever have a child. So I literally wrote my own maternity leave policy. And then based on that, I was able to design new systems like paternity leave policy. And we were able, like, we learned along the way, like, oh, making people take time off when they have children is actually a really good thing and it pays dividends in the long run. I think this is a super challenging time for all working parents, or at least every single one that I have met. But it's also a really interesting um, way to give evidence that you really don't have to be in the office every minute of every day to get work done and to be effective. And I think that ability to do a great job at work and be a great parent and not have it be mutually exclusive at the right firms is increasingly being celebrated. And that's a terrific thing for all parents, not just women.
Great. We have one Q&A right off the bat. And I think this is great. So I'll let Therese or Amy take this one. But do either of you have any advice for entry-level opportunities in hedge funds if you come from a more of a liberal arts background? And I would say, as I mentioned, I was business econ, and I was shocked that my skill set translated to evaluation, which was a more technical field. But I'd like to turn that over to Therese and Amy as far as, like, let's say you were an English, you majored in English, or you took a different path. What advice would you have?
Therese, why don't you go first and then I'll add on.
I think when I started in investment banking, there were tons of people with non-traditional backgrounds, and I would actually say most of the investment side people at my firm, a good chunk of them, and over the last 20 years, as I think of the various people who've been in analyst roles, did not major in business or in accounting, and I think, but I do think it's important, especially as I mentioned before, with the smaller size of a lot of hedge funds, to try to get some of that training somewhere, whether that is taking additional classes or additional, in the summer or at night, or trying to get yourself into perhaps not a hedge fund program initially, but getting into finance in some other way to build some of those skills up, because a lot of hedge funds may not have the capacity for a lot of training, just given the smaller size. But I do think it's definitely possible. I know, I'd say most of the people that I can think of did not, in fact, major in business. And so it is a path that is open. It may take a little more work than if you were graduating, with a business undergrad degree. But that doesn't mean that long term the opportunity is not there.
Yeah, absolutely. And I would say I view a lot of investment firms as really valuing critical thinking, ability to communicate, and depending on your role and the type of firm, I think a lot of these soft skills are really important. And a lot of the technical skills, frankly, I think we learn in that first analyst role, not necessarily in college. College, the college coursework is super important as building block to learn, fundamentals, but a lot of the really technical stuff you just get with lots of at-bats, when you're in that analyst role.
I would also echo what Therese's comment about things that you can do on the side. I was an economics major. Certainly at Sheffield, we had lots of Wharton and Harvard Business School type of folks, but we had English majors and history majors. But I think people really did put in work on the side, whether it was like, I took the CFA, and I know a lot of other people on our team did. And I think the more traditional your background is, the more impactful that can be. And that's something that people can easily do on their own and taking classes at night. But I would also be sure that when you are applying, that you're both showing your creativity, your ability to write and communicate and think differently, but also these concrete ways that you have actually shown that you're interested in the business.
And I'm
Yeah,
going to
I
let
would,
some of the Q&A pile up because we're getting a lot of very similar questions along the line of how to get in. But go ahead, Therese. Then I actually was going to ask you if there were any classes that you wish you had taken in college that you didn't, that would have maybe helped you.
I would, I'll start by echoing, I think the CFA is a real stamp that shows, I think, both your willingness to put in the work as well as your ability to master the material. I actually, I went as part of preparing for this, and I looked at some of the classes they now offer at my alma mater, and I feel like the econ classes have improved in terms of preparing you for a career versus what was available. My economics major was much more theoretical, a lot of proving macro and micro theories. But you know, I wish I'd probably taken more in terms of corporate finance or financial modeling, you know, maybe more accounting, any sort of, we focus on debt. So corporate restructuring classes would be interesting if there's anything like that available. We actually, as I said, we focus on debt. That's a whole area of the market I didn't even consider before I started working at Caspian. I really only thought about the equity market. So, you know, to learn more about some of the other instruments that are available besides equity, I would also say one thing that's probably important to do personally before you are thinking about working at a hedge fund and would probably help you in applying to one is to really think about your personal risk tolerance. Are you someone who wants to be making decisions, trading decisions, and living sort of with the upside and the downside of that, and you know, running a portfolio? It doesn't have to be real money, but really running a model portfolio and being honest with yourself about those decisions. I think one stumbling block people have in interviews is you know, they're asked, do you invest at all? And people who are really there saying they're desperate to be an investor for your firm haven't ever thought about what they would buy if they had $100 to spend in the market. And so I think you should think about, you know, how would you spend that money if you were running a portfolio? I think that's a good exercise.
That's a really good one. I think we all need to ask ourselves that. Stephanie, yeah, I was going to say.
I would echo what Therese said about economics. I had a micro and a macro class, and I wish that there had been a much deeper dive into economics. I recommend doing as much as you can to anybody who is looking to get into any field in investing. And then also I peeked at the Q&A, and somebody asked about alternative paths into alternatives rather than investment banking. One thing I recommend to young people I talk to is credit analyst programs. And Laura, I think you might agree with that. In particular, I think that the foundation you get in doing a credit analyst program at a bank is so strong, and it's something that I wish I had done as well coming out of school. I didn't go into investment banking. I took a meandering path to the family office world into allocating, but I think a credit analyst program would have benefited me a lot as well.
Yeah, and within the big four or consulting firms, I think, I mean, somebody with a, you know, McKinsey background, or even I was Ernst & Young and I was in transaction advisory services. And what that got me was I got experience with Fortune 500 companies. I got to see how many different companies presented financials, thought about forecasting. I got a lot of, you know, sort of just office experience working with different teams. And, you know, ultimately, you know, kind of, well, you know, I feel like I got really good exposure for my age, having to do, you know, valuations for some really big companies. And even though it was post-deal, it was a really good learning experience just out of school. And I think, you know, actually segueing into, we've talked about kind of, you know, there's several different roles within a hedge fund, but Stephanie, I was wondering if you wanted to kind of touch on, you know, after the sausage is made, sort of what are different roles in a portfolio that hedge funds can have? You know, they're not all created equal. So how do you think about that, and how might different people in our seats look at hedge funds differently?
Sure. So the way I think about it, a hedge fund portfolio should be thought about in the same way as any asset class going into a diversified portfolio, and that's to provide diversification. And so, I have, and I know Laura has, a policy asset allocation, and we're trying to make investments within different asset classes to achieve the best risk return balance we can for our constituents. And in my case, it is this family who has created an asset allocation that is targeting returns. They want equity-like returns. They're not looking necessarily to protect capital, but instead to generate more. Frankly, the more they can make, the more they can give away in their philanthropic endeavors. So, we're looking to make money. Hedge funds in particular, and this balances off of what Therese says. She was talking about hedge funds and hedging and managing risk. Hedge funds as a pool can help you manage the risk of your overall portfolio. And so you've got that managing risk in the individual fund, but then also in this portfolio overall. And so we want at Gore Creek, and I know a lot of other firms want our hedge funds to obviously generate a return while also sort of dampening volatility, bringing that standard deviation down and protecting from the risks of when the market's going down. Hopefully your hedge funds aren't going down as much. And I think a lot of people, there are two big ways firms use a hedge fund portfolio. And one is to generate return and hopefully dampen volatility, keep up with equity markets, but in a way that's less correlated with equity, so that maybe when equity is going up, your hedge funds aren't going up as much, but then when equity is going down, your hedge funds are hopefully protecting and not going down as much. There's also the flip side is you could prioritize that risk management and dampen volatility and protect on the downside at all costs. And you might give up some upside, some of that return, but that's because this pool is being used to really protect what else you have in the portfolio. And I think we can get into what's really interesting about hedge funds is how they actually achieve that, is what Therese was talking about, but then there's all the different kinds of hedge funds, and how you piece the different funds together into a portfolio can help guide whether yours is going to really manage that risk or generate that return, or both.
And I think to your point, and one type of hedge fund we haven't talked a lot about is sort of a quantitative systematic manager. And so both, as we're talking about different career paths, if you have a real interest in programming, modeling, economic theory, but you aren't wanting to make calls on specific instruments, for example, there is a bunch of, and that background is a bunch of math PhDs or a bunch of kind of economics PhDs, but they have to know how to write code. But it's a totally different skill set, and also serves, a very diversifying role in a hedge fund portfolio. And just for context, our portfolio looks at hedge funds, really not trying to shoot the moon. Ours are really a diversifier and a fixed income replacement. So, really looking for diversification versus, the core of our risk in our portfolio, which is equities. So we're really looking for things that have lower equity correlation, particularly when equity markets are down. So we'll look at a lot of, down market capture statistics, as Stephanie alluded to. And so, I think it's good to maybe, I guess, Stephanie, can you give another example of a hedge fund you've encountered in your life that might be something more esoteric or different, something that's not equity or credit?
Well, our pools have definitely been very equity or credit focused, but I think what's interesting is within some of these, the way that our portfolio is structured now is we want our managers to be opportunistic across the cap structure. So I think that's some of where our more interesting investments lie, is that we're not just in a fund that's doing equity long short, or that's just doing distressed debt, but we have these managers who are looking across the spectrum, and frankly, they can react much more quickly than we can when the markets are changing, which worked out for us very well in March when all markets were plummeting. These managers were able to sort of pull their levers and exposures and the hedges that Therese talked about that, helped to really protect the investments. And then when the markets turned, they were able to take advantage and go up on that upside. But, I think what's more interesting about some of our funds is just the wild variety of sectors that they invest in. And, it's anything from, the casinos to the airlines, which you think would be a terrible investment right now. But a lot of our hedge funds have made money on these investments because of playing it right, because of hedging it right. And so really, the creativity that these managers can have with their portfolio construction, the variety of strategies that they can invest in, all of the derivatives that they can go into, equity and first lien debt, second lien, mezz, what have you. They can just be all over the place and make a really interesting portfolio, which goes towards that diversification we look for.
Yeah, we view the ability to pivot among opportunity sets as one of the biggest roles of hedge funds within our portfolio, because we as LPs, there's a governance process. Every time we want to invest in a new manager or move money, we can't do it as fast as the managers in the market can. And one question came up across that this kind of is related to both of it about, are you constantly monitoring the market, and is it a very fast job? So I will direct that to Teresa and Amy, but what's the cadence of decision making? And kind of, again, to your knowing thyself and your risk tolerance, how high pressure is it, both on the investment side and on the risk side? And I know this will differ depending on the speed of trading and the type of strategy you're in, but Teresa, any thoughts on that question?
Yes, it may be an unsatisfying answer in that I think it depends. It depends on the fund and the strategy, as well as the market that you're investing in. There, in my time as an analyst, there would be times when you would have weeks to take a look at a company and really dig in and sort of know everything about it before you had to make a decision on it. And there are times when, something is announced and a company is suddenly trading at prices that are attractive and you've never looked at it before, and you're trying to come to a quick conclusion within hours, which is then, followed by additional work. But I think one of the hardest things in investing for anyone is the trade-off between information and time. And so by the time you have perfect information, so does everyone else. And so the opportunity is usually gone. And so you have to learn how to get enough information that you're comfortable in making a decision. And then, as I said, usually continuing the work. But it is, it's a skill that the best investors have. They know they're able to figure out the right trade-off between information and time. And it's something that you get with practice. In terms of day-to-day and how quickly things change, there are days that are just completely frantic and hectic feeling, but also it feels, at the end of that, it feels very rewarding. And there are days that are slow, and that's true away from the investment side of the business as well. There's one of the things I like about a hedge fund from all the sides I've seen it on is my day is never the same. And now that I'm on the operation side and helping to manage the business, I certainly didn't expect to be dealing with questions of COVID-19 and how do we reopen the office and things like that. But, that's a huge example of the tiny fires that you put out all the time. And so it's some days are crazy and some days are very relaxed. But and whether you have to monitor the market all the time, just circling back to the question, I think really depends on your fund strategy and whether you're taking a short-term or long-term view on things. You certainly have to be looking at news for individual companies that you're invested in, but we don't live and die on every basis point move in the S&P. So.
Yeah, I think that's really well put. And the only thing that I would perhaps add is there's limitless information at this point. And I think one of the other challenges, besides sort of navigating the drinking of the fire hose of information and sort of trying to figure out the signal from the noise, is finding the balance between, I guess, what I would call perseverance and believing in your thesis, at least for fundamental investors, versus humility. At what point are you sticking to your guns in a appropriate and disciplined way? And at what point are you sticking your head in the sand and refusing to acknowledge information contrary to your thesis? And I think for fundamental investors, that is one of the things that separates the good from the great, is having a combination of process. So from someone like Therese or me stepping in and being like, you need to reevaluate this position because you've hit a risk limit, and sort of intellectual humility to go and re-underwrite things and understand what are we not getting, or are we actually right and the rest of the world's wrong? That's super hard.
Stephanie, so I know you've now had kind of this seat at a couple different family offices. How has your approach to hedge funds been different or the same at the two different pools?
That is a good question because the two portfolios had such different objectives. And yet we still did the analysis in a very similar way. And I will say one thing that family offices have in common is that they are all wildly different from each other. There is no family office is the same. But interestingly, analysis is, and this even goes back to somebody's question about sort of a non-business or non-finance path to investing. We can teach you anything as long as you're detail oriented and analytical. And so that's why this analysis is very common from firm to firm, is we want to know how well has a fund performed on the risk side, on the return side, but then more so digging into a lot of that qualitative stuff. How are they making decisions? And so we want to talk to the portfolio managers, but also the analysts on the teams to find out how deep are they digging into an investment? How much are they looking? What are they writing and sharing with their team? Can we read their write-up? And then frankly, getting into the same room, which is what Zoom due diligence has made difficult, but getting into the same room and seeing how the team interacts and making sure that there is camaraderie on the team, because culture is so important. And we want to be able to see that because we want to make sure we're with good partners. And so frankly, even though our hedge fund portfolios between the two family offices are very, very different, and in the fund lineup and also in what they're meant to be doing, but how we got to those decisions is all very much the same.
While we've been talking, there's been a couple questions about some other kind of roles adjacent to our particular roles, but I want to address them because this is another lingo I don't think I knew exactly what it was, which was prime broker. And so Therese and Amy, you probably deal with the primes quite a bit. Can you maybe define what a prime broker, what is prime brokerage, and sort of what's a day in the life and also I think touch on maybe the cap intro piece of that prime brokerage. So kind of what services do the investment banks provide you?
Yeah. So you can think of prime brokerage as basically custodians of some of the assets of hedge funds. And there's now been more variation in the type of people who will hold on to the assets and keep them safe so that investors can verify that they are what they say they are. They also provide financing and stock loans. So if a hedge fund wants to go out and short a stock, they need to beforehand go out and obtain what's called a borrow. So they need to actually get a specific set of shares from someone, and there's a cost for that. And so the prime brokers will manage that. And the capital introductions piece is basically the prime brokers. It's a pretty competitive market, and they realized probably in the early 2000s that they could engineer a win-win by capturing information about all of the hedge funds that were on a given prime brokerage platform and having information about all of the investors who were interested in those investors, whether it's family offices, endowments, foundations, fund of funds, and effectively acting as matchmakers. So saying, okay, like for example, I was at Morgan Stanley. So, okay, these are the hedge funds that prime broker with Morgan Stanley, and an investor could say, who's new, who's doing really well, who can I visit when I'm going to London? And you could just sort of like put them together, and there was no fee to the prime broker for that service. But effectively, when the assets of the hedge funds on your platform grow by virtue of either good performance or asset growth, the model is built basically such that the prime brokers would make more money from that, and it becomes somewhat of a virtuous cycle.
I I think you've captured almost all of it. I mean, we also, I would say one other thing that we see the prime brokers do is they do a lot of research on the industry, and they do a lot of research that sort of helps provide me as the COO with information about what other funds are doing. Not only how are they performing, but how are people approaching comp? How are people approaching you know, we have questions on ESG investing. How are people dealing with COVID-19? They run all sorts of like research pieces and surveys that they gather anonymous data from the people on their platform, and then provide it to you if you're one of their clients. And they hold conferences. They do to help you build a network, because one of the things about a hedge fund when it's run as a small business is there may be no one else at your firm who's doing your job. And so knowing other people in the industry who do your job and who have similar responsibilities can help you to do your job better. So meeting, you know, I think the prime brokers also serve sort of to make introductions across different funds and different strategies, so you can build a network of COOs or a network of CFOs, and I think that's very helpful.
Yeah, I've enjoyed, you know, learning about the different functions of the prime brokerage, and I got to be a fly on the wall at one of the conferences that they put on for hedge fund COOs, and I really enjoyed conversations about, you know, how to open the pipes to trade and short in China, and just logistics things that, you know, I don't get to see, that would probably be really informative as I evaluate hedge funds.
Yeah. It was also a great entry point, by the way, into the business. Like I worked in prime brokerage when I moved to Chicago because I was new to Chicago, and I actually didn't know a lot about it before I joined. And so when we talk about kind of alternate transitions into the business, it's a very interesting way to enter as well.
Great. So, you know, and sort of segueing, because these prime brokers and different prime brokers, just so you know, focus slightly on different client bases. So you might have Goldman with a very particular type of core client, or Morgan Stanley with someone else. So depending on sort of the instrument that, you know, you'll have different mixes across books of business. But to answer the question on sort of like, what are all the different strategy types that I've seen a question come up on, Stephanie said she has a slide she should be able to share that shows that there's a ton of different strategies. So I'm going to see if this technology works to let her share her screen.
It is saying I cannot share while the other participant is sharing. So I don't know what that means.
All right, well, I'm not sharing anything. Try again, she said.
Okay. Here we go. So the question was to talk through the different types of hedge funds there are. And so I wanted to share this slide, which is one that we created for a
Stephanie, this is awesome.
To our family. You like that? So it is unbelievable the number of hedge fund strategies there are, and this might not even scratch the surface. But this is what we presented to the family we invest for, to let them know, like, this sort of the green and the light green is where we've been focusing our time. But there's so much out there. And so I think I'll touch maybe on just a couple of these if I could. Hedged equity goes towards that like stereotypical long short equity fund that's, you know, going long equity and short equity, and it could be short an equity basket, it could be short specific equities to balance risk from anything that's in your long portfolio. You could have, it says short bias, that's a fund where they're mostly or all short. There's long bias, they're mostly or all long. You've got credit. Within credit, it's unbelievable the number of different investments you could make, and just following the lines, you could even do long short credit, corporate credit. There's relative value, and multi-strat is another big group, and that's where you're using a lot of arbitrage, where, you know, you're buying and selling similar securities or different securities from the same firm to sort of take advantage of price differences there. Merger are the two players in a merger transaction. You might play those prices against each other. And then you get into global macro, which is just the black box of everything programming and trading. And each one goes even further out from there. So this gives you an idea of, if there is an area of investing you like, or an asset class, or some esoteric something or other, there is a hedge fund that does it.
Yeah, and it's interesting because I look at that chart and, we have a couple boxes that would, for us, would be dark green that we spend more time on.
Mhm.
Uh, Specifically systematic macro, which, for our portfolio serves a really important role given its liquidity profile and diversification.
Mhm.
But
Right. Yes.
wonderful. So,
And that's what's interesting is our portfolios are so different because we want volatility dampening, but ultimately too, we're gunning for it. We want hedge funds were originally created decades ago to generate returns. And
yeah,
that's how we're lucky that we're able to use it that way just because the risk tolerance of our family is so high.
absolutely. We've gotten a couple questions on ESG. I guess maybe I'll kind of merge a couple of these together. So not just on the investing side, but as you guys, all of us, I guess, as we're looking at the hedge fund industry, how has the conversations changed? And maybe the more philosophical question is ESG something that should be explicit, or is it something that sort of can bubble up more bottoms up by saying, like, for us, we view it as like, we want to pick good partners that are going to do the right thing when times get tough, and that really does line up very well with firms that also have good ESG policies, because it's just showing that they're good citizens. And ultimately, documents are super important, legal protections are super important, but when things go wrong, we all know, and Therese, in the credit world, you've seen this, that documents, can sometimes not mean that much. And so you really ultimately have to be with good actors. So we look at that in terms of selecting hedge funds, but maybe to all three of you, how do you incorporate ESG in your day-to-day lives, at professional life?
I have a secret plan that is not so secret if I share it here, but I would love at some point to have a dedicated piece of our portfolio focused on ESG. Right now, we don't have any sort of explicit allocation to ESG or to impact investing. I would love to have a dedicated pool. But then I think about it, and I think on the flip side, to Laura's point, I want everybody in our portfolio to be concerned about this. And I think one of the reasons that ESG and impact investing have had a hard time gaining traction is because people equate those strategies with lower returns. And that is absolutely not the case. And everywhere else around the world, but the United States, they don't have to point out that something is impact or ESG because it just is. And they're just doing that right thing. And part of their plan to make businesses better always incorporates those things. So while for the purposes of our portfolio, I'm secretly hoping to have a little pool dedicated at some point in the near future. My hope is that all of our managers are doing that right thing, because I know ultimately our family does care about that.
Yeah, I think what's really challenging is there's a little bit of what I would call ESG is in the eye of the beholder. And so at my former fund, we definitely did some mandates for faith-based organizations that really wanted to exclude out certain businesses. And that was like fine because it worked well within the things that we invested with. But I think where it becomes really challenging is areas like energy. Because by its nature, energy and materials are just environmentally destructive industries, but they still make up a pretty big portion of the MSCI, EFA, of the S&P. And so I think it becomes challenging to keep everyone happy. And so I think that the best that people can do for now is just really communicate well and try to make sure that there's alignment between how your fund, because hedge funds, as we talked about, are flexible small businesses in many instances, and to make sure that how you're viewing it and how your investors want you to be viewing it are really tightly aligned. And I think then you'll be okay. But it's super interesting. I serve on the investment committee of a nonprofit, and they're just not ready to, and it's a faith-based one, and they're just not ready to use this as a criteria yet because of what Stephanie said about this perception that the returns won't be as good. And I'm with you on the wish list of, I hope that we can get to the point where we can all have our cake and eat it too, so to speak.
I'll echo that. I think it means we're at the point in the market where it means different things to everyone, and that communication, I think, between the investors and the manager is super important. Particularly if you're managing sort of a commingled fund with investors who have different sensitivities to it. That's just important to be very transparent about what your approach looks like.
And it also gets to be quite a gray area in that even within energy, for example, you know, simply divesting, you know, carbon, for example, you have to think about, you know, the marginal professionalization of an energy company and what that means to pollution and waste. And so in some format, professionalization and improving efficiency in operations is ESG friendly. And so, you know, we do see even oil and gas firms with a big focus on ESG, and part of that's employee safety, making sure that they, you know, leave their sites better than when they got them and things like that. So it is such a wide spectrum of approaches. We've also been focusing a lot on diversity, and in particular, increasing the funnel of diverse talent in our industry. And I think that's something industry-wide that we all have a lot of ground to cover. And part of that comes to recruiting in different places, and part of that comes to you know, dealing with unconscious bias, and really, but ultimately, allocators like ourselves, you know, are really focusing on casting a wider net and making sure that we, you know, look in many different places, high and low, to help back, you know, emerging talent, and particularly, you know, focusing on agitating with the industry to look inward and say, you know, it's an apprenticeship business. Are we giving young people a chance to get apprenticeships that perhaps have, you know, a non-traditional path, that versus the, you know, sort of median hedge fund or private equity, you know, candidate 10, 20 years ago. So I'm hopeful that in a decade, you know, we have a lot more diversity. And to wrap up, I would say maybe round robin, let everybody just kind of give, you know, sort of what's your less than 60-second elevator pitch as to why someone should pursue a career in hedge fund investing, and go.
It's a great way to see how so many parts of the world are working together, and this global economy is a thing. And I think with the hedge funds, you get this great high-level view of how everything's working.
I'll go with approximately 3% of hedge funds are managed by women. That's not enough. It's not even close. It's not even in the ballpark of close. And I see we've got more than 100 of you in the audience, so go get them.
I would say it's fun. I like my job a lot. I've been at the same firm for a long time. It's less structured. It is fast paced. It's interesting. You build a broad set of skills. You know, and it's a challenging environment. And I wanted to throw one thing in. Someone asked, how do you find out if a firm's a good fit for you? You just have to meet the people, and then you have to go with your gut. And so it's you know, it is, places are small enough that the people you work with have a very big influence on how your day-to-day is. So meet as many of them as you can, as many times as you can, and then see who you wouldn't mind having lunch with for hopefully the next 18 years.
And do references on them. Use your LinkedIn network to do references on these people.
Oh, that's a really good point. Yeah, I would echo all of that. And I think, you know, honestly, you know, from my seat, mostly what Stephanie said, my hedge fund portfolio is something, you know, because I'm a generalist, which is a very unusual position. You know, I see it all. I see private equity, I see hedge funds, I see real estate. And I always, you know, sometimes I kind of joke and I say, you know, hedge funds are like Brussels sprouts because they're just so important. They're like the important base of the portfolio, and they serve and like they're just such a good. They're like a superfood. Now that's not always the case with every hedge fund, but the point being is, you know, you can really pick off of a menu of such a diverse amount of strategies, like Stephanie illustrated, and so, you know, it's just such a helpful tool. It's like an incredibly helpful tool in a portfolio, and so, you know, it's something I really enjoy talking to people who are deep diving and doing relative value across different parts of the capital structure or different, you know, industry sectors. and how fast they can move capital and find an, a dislocation. It's something that every time there's certain hedge funds that can do that I get off the phone and I wish I had known about that career path, 15 years ago. So definitely somebody who's, very, curious, intellectually curious, and really kind of thrives on no 2 days looking the same. I think that would be kind of, if that's you, I think it's something to consider. So thank you everybody for joining. And I hope we did a little bit to kind of demystify a day in the life. And just really happy to see 100 people here just learning about, kind of what this career path is and different ways to access it. And thank you guys on the panel for taking time out of your busy day. Really appreciate it. Good to see everybody virtually.